Thank you for joining us this afternoon. Today is July 7th, 2015. My name is Joe Terril, president of Terril and Company in St. Louis, Missouri, private wealth management firm with approximately $775 million in discretionary assets under management. Lots to talk about. Brian Curtis, thank you for helping us with our filming as always. And Brian, let's get right into talking about Greece.
Okay.
It seems like we've been talking about Greece now for 5 years, where in reality it's really only been 2 years. But we finally reached a point where either Greece is going to default, leave the European Union, or some type of debt restructuring will take place in order to keep them in the European Union. This is a situation where short term, because of all the uncertainty it creates, it's negative for the markets. But we believe that longer term, this is very positive for the markets, meaning that as soon as we can get past this, we look for the markets to go back and actually rally, no matter how this is resolved. If it's resolved with Greece leaving the European Union, attempting to go back to use their drachma as a currency, it'll be an unmitigated disaster for the people of Greece. There literally would be lack of food in the country, lack of very basic ingredients. No one's going to take the drachma. The devaluation from the euro to the drachma could be as high as 75–80%. Consequently, as that's short-term horrible for the people of Greece, longer term, it's very good for the rest of the world to witness what a disaster it was for someone who does not want to participate in the modern world economy. By the modern world economy, I mean one in which there is a sense of you must figure out what you're going to do for a living, what product you're going to manufacture, what services you're going to offer to the rest of the world to make a living. And this doesn't make any difference what country you are. Greece is a holdout of the old socialist notion of that's not necessary. We don't have to work for a living. We can continue to borrow money or print money to live beyond our means. Greece can try and defy reality for as long as they want, but it isn't going to work. I hate to see the citizens and the people of Greece with their great heritage go through it, but it would be very good for the rest of the world to see what a disaster it is for a country that has that attitude. In longer term, that would be very positive for the balance of the world. The balance of the world will see how important it is to have more common means of exchange for conducting business, how having equalized trade rules, how breaking down artificial borders that separate us as people and allow for the free movement of not only people but goods, services, etc., as well as encouraging people to be productive, is very positive for the world. So this is why I say short term it's going to be horrible for the people of Greece, maybe even would result in Vladimir Putin and Russia volunteering to come to their aid and basically maybe make them a satellite then of a Russian government, but hopefully not. Hopefully they come to some scenario, but we look at the odds as 80 to 90% that Greece is going to go through the horrible disaster because they seem intent on refusing to want to change. And anyone right now from any country that is refusing to bring themselves into the modern world of technology, into the modern world of communication, and the resulting business flows and things like that, that modern world represents, will suffer and pay the price. We might as well have Greece be the poster child for it and show everybody what a disaster it's going to be. And I think the people of Greece, unfortunately, are intent on going down that road and really don't understand what a complete disaster is waiting on them. Now, with that said, investment markets do not like the uncertainty of not knowing how this is going to work out. Markets have not been anywhere near as bad as perhaps what some people were predicting, because again, I think many investors and people around the world realize that in the scheme of things, Greece is a very small economy. There's a lot of money in debt there, but that can be handled, will be handled, and it's not going to cause a credit crunch, credit panic as everyone begins to worry. Could there be a domino effect with everybody begins to go broke just simply because Greece did? The answer to that question is no, will not happen, and that's actually why the investment markets have done better than what most people anticipate, and we believe they will continue to do better. Would love to get this Greece situation behind us, but it's not going to cause a major correction in investment markets around the world. The other issue that has been on everyone's mind late spring, early summer, has been the outlook for interest rates. Markets are convinced that interest rates are going higher and are worried that somehow that might cause a major panic in the markets, and markets may go dramatically down. Higher interest rates potentially might create economic chaos. None of that is true either. Interest rates on the short end in the next 12 months may go very marginally higher. Longer term interest rates, as witnessed by 10-year bond yields around the country, or excuse me, around the world, we do not anticipate they're going higher to any meaningful amount. This comes down to a simple scenario of there's more world capital looking for yield than there is available demand for the money. So we see a scenario where a year ago a US 10-year bond was yielding 2.18, and as we speak today, a 10-year bond yielding 2.2, literally unchanged. Unchanged in yield, even though everyone anticipates that yields are going up, they have not gone up, and they haven't gone up because there's too much capital out there, there's too much money all over the world. As soon as you begin to see any increase in yield, here come the buyers. At the same time, you're seeing less demand for money all over the world. Until that demand equation can change, you will not see any meaningful increase in longer term interest rates. And consequently, there is some opportunities there in things that people believe are going to go down in price because of a big increase in interest rates. They're not going to go down, or they may already be down in price, but it creates a good opportunity to buy those type of assets because there isn't going to be a major increase in the interest rates in the next 12 to 18 months. we remain mildly bullish, and I stress mildly bullish, on stock prices and bond prices. Anything that's interest rate related, we remain positive on. This is the type of market where there probably will not be dramatic gains, but yet we will get small gains, particularly with dividend-paying stocks, floating rate bonds, certain fixed rate preferred stocks. We believe there is good returns to be made in those particular type of investments. There is, if you will, no alternative and no other place for people to go with money. Once they're finished worrying about Greece, once they're finished worrying about the interest rate structure, they will return to these type of investments because there is no logical alternative. There's nowhere else around the world to go to them with money other than sit on it and make a zero rate of return, and in some cases actually make a negative rate of return. So we, as we mentioned, continue to feel this money will continue to flow into assets at a mild rate, cause mild price increases. We'll be anxious to see corporate earnings reports, which will start here in a couple of days. We don't look for big increases in corporate profits, but then again, we think corporate profits will be in good shape. So until we update probably in 30 to 45 days, we appreciate you joining us this afternoon. Once again, my name is Joe Terril, President of Terril & Company, Independent Wealth Managers in St. Louis, Missouri. And Brian, I thank you for your help today, and remind me in 30 to 45 days to do an update. Thank you.